Welcome to BARR Financial Services market commentary for the second quarter of 2011. Thank you for all your wonderful comments on my 5-star wealth manager ranking and being featured in Forbes as one of the top firms in Florida. Your comments are greatly appreciated, and no, my head has not gotten that big. U.S. equity markets have been highly volatile during the second quarter. Despite a strong start, equity markets sold off in May and through most of June, as investors began to fret about disappointing economic data and the deepening sovereign debt crisis in the Eurozone. Although risk aversion characterized the mood for most of the period, the markets rallied towards the end of June as the threat of an immediate Greek default was averted. This left the markets flat for the quarter. The stock market rally, which started March of 2009, has the overall growth of the S&P up 104.7% and is just 8.4% below the peak reached in October of 2007. Setting new market highs are in our sights, and while I remain convinced that the economy is in recovery mode, it is important to remember that recoveries that occur in the aftermath of a financial crisis tend to be bumpy and slow. Our current recovery is no exception. Of the last 10 recessions, the average bull market run lasted 68 months, with an average increase of 176%. Despite all the weak economic data, I do not believe a recession is likely and that the foundation for recovery remains in place. There are some positive signs that provide reasons for optimism. Gas and oil prices have fallen from their highs earlier this year. The disruptions from the Japanese earthquake are fading. Deleveraging trends are slowing. Overall demand levels remain decent. The labor market is slowly recovering. And despite the rhetoric over deficit issues, fiscal restraint in Washington is unlikely to pose a significant drag on growth. Equity valuations seem reasonable relative to expected growth in corporate profits and dividends and in comparison to prevailing interest rates. Current PE ratios versus the 20-year average show that large cap and growth equities are undervalued and there's opportunity for growth. This is important as we hold strong positions in these areas. The forward PE ratio of the S&P 500 index, most recent reading of 12.4 times, is well below the average of 16.4 times. Again, suggesting stocks are undervalued and have room to grow. This is a reflection going back 17 years to 1993. The Chicago Board Options Exchange Volatility Index, the VIX, a measure of implied volatility of the S&P 500 index that is also known as the Fear Index, highlighted investors' uncertainty for the quarter. While overall market volatility dropped, moving from 17.7 at the start of the quarter to 16.5 by the end, the VIX reached as high as 22.7 at mid-June, mainly from the Greek default issue. According to the results of the Business Roundtable's Economic Outlook Survey, the CEOs of America's leading companies anticipate higher sales and plan to increase capital expenditures and employment over the next 6 months. 87% of the CEOs anticipate higher sales, and as a result, more than half plan to increase both capital spending and hiring. This continues a positive trend for activity heading into the second half of 2011. And cash on corporate balance sheets now accounts for almost 30% of current assets. This puts them in a very strong position to benefit from the continued economic expansion. And net profit margins are almost at pre-recession levels. This means corporations in the U.S. are strong and should benefit the markets in the second half of 2011 and into 2012. As indicated by the graph, Real gross domestic product, GDP, for the first quarter of 2011 was 1.9%, compared to the 20-year average of 2.5%. GDP for the second quarter is estimated at 1.3%. The lost output during the Great Recession has been fully recovered by $80 billion, indicating the economy is still in an expansion phase. The big question is at what rate of growth? Most of the economists we follow expect modest ongoing global economic expansion and continued growth. The Conference Board's leading economic index, LEI, for the United States continues its vertical climb and increased 0.3% in June. This indicates a strengthening business condition in the near term. The Coincident Economic Index, CEI, a monthly measure of current economic conditions, also continued to rise. These leading indicators point to slowly expanding economic activity in the coming months. Political stalemate. As of this writing, the debt ceiling crisis has heated up, with Moody's and Standard & Poor's threatening to lower the credit rating of the United States debt. The financial markets appear not to notice or to care, but may simply be expressing a confidence that the debt ceiling will be raised in time. After all, we've been here before. As dysfunctional as Washington lawmakers are, they aren't foolish enough to cause a self-inflicted financial calamity. The current debt ceiling crisis is a manufactured crisis. There are two issues here. One is the long-term budget outlook. The other is the debt ceiling itself. These two issues have been merged together to create the current crisis. But we need to remember, stupid is as stupid does. Employment. The June employment report was disappointing and payrolls rose less than expected. There were really no bright spots in employment in the quarter. That does not mean that the economy won't recover in the second half, but headwinds will prevent growth from being a lot stronger. Remember the Roundtable's CEO report mentioned earlier, with over half planning to increase hiring. The first half of 2011 is now complete, and it certainly had its shares of twists and turns. The first quarter was strong. In fact, the increase in the S&P was the largest first quarter gain since 1998. After all the disruptions, the second quarter should be viewed as positive, even with the market being flat. We faced the epic earthquake and tsunami in Japan, a spike in gas prices, a slowdown in China, a never-ending debt crisis in Greece, military acts in Libya, the budget deficit and debt ceiling in the United States, and QE2 ended in June. This impressive resilience can be attributed to the underlying strength of the global economy. The unexpected events of this past quarter underscore the need for vigilance. It is quite possible we could see a repeat of last year with the market surging towards year-end. There remain various sources of volatility and downside risk, including European debt issues, uncertain employment growth, the weak housing market, the ever-increasing debt ceiling, gas and oil prices, inflation worries, and geopolitical risks. Ultimately, I expect the U.S. economy will continue to improve in the second half of 2011, and also expect the backdrop will become friendlier for stocks. The bottom line is that our portfolios are well diversified, and we will continue to benefit as we move forward into the uncertain future. Please forward these commentaries to your friends and family so they can benefit from this information. As always, let us know how we can better serve you and your needs. Thank you for listening and your continued support.